Today we're learning how to calculate and record depreciation, specifically straight-line depreciation today, and not the most fascinating of subjects. If you're here for a good time, you really need to visit a life coach or something, because these are kind of boring subjects, and I have to agree, but I'd rather be fishing or backpacking. But hey, sometimes we just need to learn this stuff, and so we are talking about depreciation today, straight-line depreciation. Welcome to the Video CPA. I'm Michael Scott. I am the Video CPA, and in this channel we help you to understand your accounting and your taxes. So stay tuned. I'm a certified public accountant and a certified management accountant. I've got 45 years of tax and accounting experience, and I've worked with some of the nation's largest firms, and I've also owned my own CPA tax and accounting practice for over 20 years. So nice to have you here. During my 45 years of experience, I have noticed that one problem that taxpayers have in understanding their tax return, or understanding their accounting for that matter, is that they don't understand depreciation. And depreciation seems to be one of the hardest things. And when you decide to depreciate, when you don't, and how you calculate it and how you record it in your financial books, if you're actually keeping your financial books. So I'm glad to have you here. Stay with me, and if you haven't subscribed, I want to thank you for subscribing. If you haven't subscribed, hit the little red emblem in the bottom of the right-hand corner and subscribe to this channel. If you do, you'll stay in touch and keep in tune with future videos that I might make, and you'll be allowed also. You're allowed anyway, actually, to provide input on future videos. So in the comments section below, if you would like to see a particular topic discussed on this channel, go ahead and put a comment in there, and I will see if I can't work up a video on that, especially if there's enough interest by other watchers and subscribers. All right, let's get into it. Like I say, we're talking about depreciation today, tax depreciation. So we're explaining tax depreciation. We'll talk a little bit about how depreciation, why we depreciate today, and about the difference between financial and tax depreciation. Let's get going then. First slide, you'll see a disclaimer there. That's we do have affiliate links in the description. So if you want to purchase something through Amazon, if you go through this channel, we do get a commission. It doesn't cost you any more, so we would like it if you do, but we need to make you aware of that. Also, we have our educational disclaimer up here, which says I try my best to have all of this information accurate and professional, but you need to make sure that you look into it for yourself as well. All right, depreciation. Why do we calculate depreciation? It goes back to what we call in accounting the matching principle. And so the matching principle, in short, says that we should match expenses of the period with the revenue that's produced during that period. So if you buy an asset that lasts over a year, if you buy one under a year, you don't have to depreciate it. But if you buy an asset with a useful life over a year, you should make an attempt to depreciate that asset so that that asset is spread over the period of time that it might produce revenue. And so that's the matching principle. It just says that we need to match the expenses of that asset. If it costs $10,000, for example, and you depreciate it over 10 years using straight line depreciation, you're taking a little less than $1,000 a year. And that way you don't recognize all that expense, the $10,000 in one period, but you recognize it in 10 periods, and you recognize it over the period that is still a producing asset and helping to produce revenue for the entity. So that's the matching principle in short. There is a difference if you look at tax depreciation and you look at financial depreciation. The two might not be the same. So if you're looking at a financial statement and you see a depreciation figure and then you look at the tax return, the depreciation might be different, and there are reasons for that. One of the reasons is that tax depreciation uses accelerated depreciation methods generally more than what your financial depreciation in your financial books do. So just be aware that there could be a difference there. All right, straight line depreciation. Accounting requires it, actually. Tax accounting requires it for the use of real estate. So if you've got a rental property or a commercial building of some kind, you've got improvements to it, the IRS requires that we use straight line depreciation. And as I mentioned on the slide before, straight line depreciation is most often used in financial accounting as well. So it can be used for other types of assets, but primarily it's used in real estate. If you'd like to use it with other assets, you have that choice. And the way the tax code defines it is it defines everything else basically with shorter useful lives, and how that should be depreciated and what useful life they should have, and then it says everything else should be depreciated on straight line depreciation. But primarily it's real estate. All right, components of the straight line depreciation calculation, and we're going to talk about accelerated depreciation in a different video. And these components would be the same for accelerated depreciation, or all depreciation actually is what they are for straight line depreciation. So some of the components, you certainly have to have your purchase amount, and that purchase amount is sometimes adjusted by things like freight, installation fees, sales taxes, of course, and other types of expenses that you incur when you acquire that asset. Also, you have to take into account with straight line depreciation anyway, and this is not the case with your accelerated depreciation methods for tax, but you have to take into account a salvage value for that particular asset. So if you've got a piece of equipment that's going to last 10 years, and then at the end of that 10 years it may be worth $500, well then you think you can sell it for $500. $500 is going to be your salvage value. At the end of 10 years, if it's worth nothing, well then you have no salvage value. But generally you'll try to record a salvage value on the books, and your salvage value is not going to be depreciable at all, so you'll have to subtract your salvage value from the adjusted purchase price that you come up with when starting to record your depreciation, or reaching your depreciable basis anyway. And land also fits into that category. It's not a salvage value, but land cannot be depreciated. So if you've got a piece of real estate, and we talked about this in the third video of my 4 videos on rental property. So land is not depreciable, and so you have to deduct that from your adjusted purchase price as well. Then we have to have a useful life. For tax purposes, your useful life is generally defined through the tax code. So depending on what type of asset it is, the tax code has defined a particular useful life for that. So residential property, for example, is 27.5 years. A piece of equipment, manufacturing equipment, is generally 7 years. So you can look in the tax code and find out, based on the type of equipment you have, as to what the useful life of that equipment might be. But that is necessary to come up with your depreciation calculation. Next thing you have is a placed in service date, and I talked about the placed in service date in those prior rental videos as well, but the placed in service date is basically when you start using the asset. It's not necessarily when you acquire the asset. So you could acquire the asset at the end of 1 year, but you don't place it in service until the beginning of the next year. And so your placed in service date would be the date that you actually start depreciating, and that would be the next year in the example that I just used, the following year, and you would start depreciating in that year. And then, unfortunately, the IRS wants to complicate things, and I'm not sure why they do this for small taxpayers. If you've got over 10 million in sales, I think these depreciation conventions are fine. But with a small taxpayer, I just don't think it makes that much difference. But they often don't think of small business and small taxpayers when they're doing these things. And so we have to have what's called a depreciation convention. And so when you look at your depreciation form, for example, it calls for a depreciation convention, and you're going to scratch your head and say, what is that? And so we're going to talk about depreciation conventions just a little bit on the next slide, so stay tuned. All right, depreciation conventions, there's basically 3 of them for tax purposes. First of all, we'll talk about the MidMonth Convention. The MidMonth Convention applies to real estate. And it only applies to the first year that you put it in service and the last year that you take it out of service or dispose of it. And what it basically says is when you put it in service, you're only going to get a half month for that month that you put it in service. And when you take it out of service, when you dispose of it, you're only going to get a half month in that year for the month that you actually dispose of it. So it just complicates the calculation just a little bit, and a lot of people, because of these conventions, really don't know what to do with them. And like I say, if you're a small taxpayer with a rental or 2 rentals, why do you have to put up with this? I just think it's kind of silly, but that's what our lawmakers do sometimes. All right, next one, MidQuarter Convention. MidQuarter Convention basically is for all other assets other than real estate. But it only applies to those other assets if they're put into service in the last quarter of the year. So, for example, October, November, December. If it's put into service in the last part of the year, you have to look at all of your assets that have been put into service during that year. And if over 40% of them have been put into service in those last couple of months, well then you're forced to use the MidQuarter Convention. All right. And what it says basically is you're going to get a month and a half in the first year that you put it in service, for that quarter that is put in service, a month and a half, so half the quarter. And then when you dispose of it, you're going to get half the quarter in the last year of depreciation. So that's the MidQuarter Convention. And it is required if your total assets put in service are over 40% of your total assets put into service for that year. All right. Next one, and this is the one you find most often used, is the HalfYear Convention. And the HalfYear Convention basically says, unless it's put in service in those last couple of months of the year, you're going to use the HalfYear Convention. And this is a requirement. Cannot be used for real estate, but it's used for everything else. So primarily it basically says you're going to get a half year of depreciation in the first year it's put into service and a half year of depreciation in the last year it's put into service. So why we've done these things, I think it's kind of silly, and I don't think it matters that much for small taxpayers. I don't know that it matters that much for large taxpayers, but this is the world we live in. Now, let's go into the straight line depreciation calculation. We talked about having the purchase price or an adjusted purchase price if it needs to be adjusted. We talked about a salvage value or a land value, and we talked about a couple of other things as well. So on this slide, you see the purchase price of the asset. The adjusted purchase price is going to be reduced by either a salvage value for the asset, or in case of real estate, it's going to be reduced by the land value of the asset. So those things are not depreciable. They need to be recorded so that you remember them, but they're not depreciable. So when you sell that asset, even though you've depreciated everything out, you still may have a land value or a salvage value that gives you a little bit of basis on that asset when you sell it. So you need to remember that, because that goes into your capital gain calculation when you make it. All right. So your basis for depreciation is your purchase price, your adjusted purchase price minus those two things, and your basis for depreciation is then divided by the useful life, and that equals your depreciation expense per year. Now, if you want it per month, you would divide that by 12 and calculate it that way. And just remember, you've got it could change in the first year and the last year depending on what depreciation convention you're under. But that is the formula. I mean, straight line depreciation is very easy except for these conventions that they threw in. So, I mean, basically it's your purchase price divided by your useful life. So if you've got a $12,000 asset and you've got it for 10 years, you know, you calculate it that way. So let's go ahead and look at an example. But before we do that, I want to thank you for subscribing again and being a subscriber. If you haven't subscribed yet, hit the button down on the lower right hand side and go ahead and subscribe, because I think you'll like this channel. There's a lot to learn. We've got several videos out there, and there's going to be a lot more coming. And so like I say, it's an exciting channel. You don't come here for entertainment, but you do come here because you need to know something, and that's why we're here. So let's go ahead on with the content. Let's go to the next slide and look at this example. And before we do that, I've got a bonus for you if you for watching this video. If you want to go ahead and send me an email at michael@scottandscottcpa.com. I'll send you a free ebook. You might say in there what format you want it in. Ebooks are either in an EPUB format generally or in a MOBI format. The MOBI format is what Kindle uses more. But if you want it in a particular format, send me say so in the email. If you don't care, well then I'll just send you probably the EPUB format. But I can send you both if you want that. So let me know. So be aware of that. It is a free book. It's an adventure book that I wrote with my daughter, and very exciting book, I think. I've written boring books, and I don't like that, but I enjoyed writing this one, and I'm writing a sequel to it. So stay tuned, and for the rest of this video, we're going to talk about, show an example, and then we'll wind this up on straight line depreciation. All right, here's an example. All right, we have an adjusted basis, an asset. It's a rental property with an adjusted basis of $250,000. Okay, now we take the purchase price. If you look at the rental part 2 series, I talk about how you come up with your adjusted basis, and it's the purchase price of the asset plus maybe some realtor, not realtor fees so much, but recording fees, legal fees, things of that nature. But it explains it all in that rental video part 2, so you might want to refer to that one. $250,000, we have to subtract the land, of course. In this case, the land's valued at $40,000, so we come up with a depreciable basis of $210,000. Okay. Now, in this case, we're just throwing in that he borrowed $200,000, which means he put down cash of $50,000 when he bought this particular residential property. All right. So in calculating depreciation, then, you're going to take the $210,000 divided by your useful life on residential property, which is 27.5 years. That's defined by the IRS. And it comes up with $7,636 per year. You're going to use that in every year, all right, except for the first year and the last year. And in those years, you're going to have to adjusted a little bit for the depreciation convention. In this case, it would be the mid-month convention. Okay, so with that, let's go ahead and look at the accounting entries and how you would count for this. If you're using QuickBooks or if you're doing it by hand or whatever the case might be, you might be using Sage. There's a lot of good accounting products out there. So the accounting entries to put the asset on the books, you're going to debit your residential property, and which is an asset. Set up your $250,000. Then you're going to credit cash because that's coming out of your cash account. That was the down payment that you made. And then you're going to credit a mortgage note. You can put a liability on the books for how much you owe the bank. So you've got a mortgage note in this case of $200,000. So that sets up your asset on the financial books. Then you start depreciating that asset. So your depreciation expense at the end of the first year, depending on your convention again, is going to be $7,636. And that will be the case every year. You only set up the asset on the books once, but then you'll be recording this depreciation expense every year. And then the accumulated depreciation is the opposite account. The accumulated depreciation is called a contra asset account, and so it goes on your balance sheet right underneath your fixed assets, and it reduces your rental property so that you can see it right underneath your rental property and see what the net value of that rental property is. So accumulated depreciation, and you know, I'm getting older now, and I've depreciated quite a bit, and I think my accumulated depreciation account is quite high right now. And but I don't know how you feel, but I'm getting there. I'm going to be fully depreciated. Hopefully, I've got quite a few useful life years left, but who knows? All right. That's straight-line depreciation and your accounting entries for straight-line depreciation. Thank you for watching, and thank you for subscribing. I appreciate all the subscribers that I've got. It's good that you're part of this team and getting updates on it. If you haven't subscribed, we'll hit the button in the bottom right-hand corner and make it so. And continue on to the next slide, and there's some added information there, and don't forget to send me that email, and I'll send you the free ebook. I think you'll enjoy it. If you like to read, it's one way to stay mentally active. And so once again, thank you for watching.